Good day everyone, I am Rek Angeles from Human Resources Development Management 1B. For this session, I am going to discuss the following: the accounting equation, the T account, double entry system, normal balance of accounts, and we're also gonna record some business transaction using T accounts. To begin with, we can see on the screen the basic accounting equation. We have here the three accounting elements that can be found on the balance sheet or a statement of financial position that shows the financial positions of the entity. To speak with or talk about it, we have here the assets, liabilities, and the owner's equity. Assets are resources owned by the business equals to liabilities, which is the financial obligation of the firm arising from the past events which are to be settled in the future.
Plus owner's equity, which is the owner's claim on the asset of a business.
To better understand the concept of this equation, let's answer this problem. Petulin's gas station has liabilities of 238,000 and owner's equity of 500,000. Then how much is the total assets? Compute the amount of the missing element of financial position. We could use the equation, which means that asset is equal to 238,000, the given amount of liabilities plus the owner's equity amount of 500,000. That makes the asset 738,000. Now, we're going over the T account. The T account is a visual representation of individual account in a form of a T, making it so that all additions and subtractions or the debits and credits to the account can be easily tracked and represented visually. Let's take a more in-depth look at the T account for different accounts, namely assets, liabilities, owner's equity, or the major components of the balance sheet or statement of financial position. For assets accounts, which includes cash, accounts receivable, inventory, and others, the left side of the T account or the debit side is always an increase to the account. The right side or the credit side is conversely a decrease to the asset account. For liabilities and equity accounts, however, debits always signifies a decrease to the account, while credits always signify an increase to the account. T accounts for the income statement. T accounts are also used for income statement account as well, which includes revenues, expenses, gains, and losses. Debits to revenue or gain decrease the account while credits increase the account. The opposite is true for expenses and losses. You can see on the screen the figure if we put all the accounts together. Now, let's take a look at the double entry system. Every financial involves at least two accounts and each entry must be recorded as a debit and credit. The terms debit and credit are used to describe the two sides of financial transaction. Okay, so let's talk about the debit. In accounting, a debit is an entry that increases the balance of an asset or expense account, or decreases the balance of liability, equity, or revenue account. In the double entry system, a debit is recorded on the left side of the ledger, while a credit is an entity that increases the balance of a liability, equity, or revenue account, or decreases the balance of an asset or expense account. In double entry system, a credit is recorded on the side of the ledger. The double entry system relies on the accounting equation. We all know from what I talked about earlier that the equation must always be in balance, which means that for every financial transaction, the total debits must equal the total credits. Here's a simple example to illustrate the concept. Suppose the business purchases an office account for 160,000 cash. In this transaction, there are two accounts involved: the office equipment, an asset account, and cash, another asset account. To record this transaction, we would also use the T accounts. So you can see on the screen, we debit the office equipment by 160,000, which increases account by 160,000, which decrease another asset. Credits 160,000 equal the total credits of the same amount and remains in balance. Remember that the context of the transaction determines whether an account should be debited or credited. By understanding the relationship between debits, credits, and different types of accounts. So, to achieve the understanding, we're now moving on with the normal balances. So, we have here this T account on the screen right now. Debits go over on the left and credits go. So, there's three different types of account that will increase with the debit, which is the asset, drawing, and expense, which will all increase with debits, while liabilities, capitals, revenue increase with credits. And after understanding all that concepts, now we're all set in engaging in recording some business transaction using T accounts.
We have here the illustrations of a service firm's operation for a month, which is represented on the screen. The illustration talk about Mr. Wonujon put up a trucking business on April 1, 2023. The Minwon Trucking is mainly a freight business but also rent out its truck on a case-to-case basis. The following transactions were completed by Minwon Trucking in its first month of operation. On April 1, owner Mr. John invested 700,000 cash in the trucking business. The first transaction, which is the investment of the owner in trucking business, both increase the assets, which is the cash and owner's equity. But first, we need to place the dates on the left side of the amount for reference. So we're gonna put April 1 or 401. Okay, moving on, as the rules of debit and credits, an increase in asset is recorded as debit while an increase in owner's equity is recorded as credit. So the entry is to debit cash of the amount 700,000 and to credit John capital, which is also 700,000. April 5, purchase a truck for cash 180,000. Now for our second transaction, purchasing equipment for cash. The asset increase in terms of equipment and also decreases in terms of cash. Assets are increased by debits and decreased by credits. So that makes the equipment is debited and cash is credited in the amount of 180,000. April 9, purchase supplies for cash 2,000. Okay, for our third transaction, purchasing supplies for cash, increase the asset or the supplies and decrease the asset, which is cash. Assets are increased by debits and decreased by credits. To be more precise, supplies is debited and cash is credited for 2,000. April 10, paid 2 months rent for the garage and office space for 15,000. This transaction is all about the payment of the rent expense. Take a look at the owner's equity, which decreases when expenses increase. The payment for garage and office rent for 2 months requires a debit to an expense account and a credit to an asset account. So that makes the rent expense is debited and cash credited for 15,000. April 12, purchase office equipment worth 10,200 from 17 marketing on account. This transaction that tackles about the purchasing of equipment on account, that makes the asset or the equipment is increased by a debit of 10,200 while the liability account or the accounts payable is increased by a credit for the same amount. April 14, paid 1,250 for business and mayor's permit. Now we're going over to the payment of taxes and license expense. Just like what I mentioned earlier, expenses are increased by debits and assets are increased by credits. Therefore, taxes and license expense is debited and cash credited for increases in expense, which decreases owner's equity. For April 18, paid the drivers and employees' salaries for 16,500. For this transaction, which the owner made payment for drivers and employees' salary, increases in salaries expense, decrease owner's equity. Expenses are increased by debits and assets are decreased by credits. So that makes salaries expense is debited for 6,500 and cash credited for the same amount. April 23 received 20,000 cash for 5 days rent starts. Our next transaction is the first income of the business. The transaction increased the asset, which is the cash, and increased the income account or the service income. Assets are increased by debits, income are increased by credits. So, debit of 20,000 to cash and a credit of 20,000 to service income is made. We should always remember that increases in income increased in owner's equity. April 27, the owner, Mr. John, withdrew 13,000 cash from the business for personal use. So for this transaction, the owner's withdrawals, a withdrawal is a personal transaction of the owner that is exactly the opposite of an investment. And take note that withdrawals are reductions of owner's equity but are not expenses of the business entity. This increased the withdrawals account but reduced cash. Debits record increases in the withdrawals account and credits record decreases in assets. And April 31 paid the mechanic 950 for minor repairs made on one of the trucks. So for the last transaction, which talks about the maintenance and repair expense, this transaction both decrease the asset and owner's equity. The maintenance and repair expense is debited and cash is credited for 950. That's all. Thank you for watching.